Okay, let's unpack this. We're diving deep into the operational reality of upstream energy accounting. For years, it feels like E&P, that's exploration and production, their financial functions were, sort of viewed as just overhead.
A cost center.
Exactly.
Yeah.
But in today's high-stakes, high-volatility market, financial efficiency has really shifted from a back-office chore to a core competitive advantage.
That shift is profound. I mean, the source material we've gathered, industry reports, year-end strategies, expert solutions, it all makes it abundantly clear. Achieving speed and accuracy in your financials is just not optional anymore.
Right. So our mission today is to give you a shortcut to understanding how the leading operators are doing this, how they manage to close their books faster, cut down on errors, and really strengthen their year-end reporting.
And to do that, you have to start with the climate they're operating in.
Absolutely. So what are the market forces that are demanding this pivot from, say, survival mode to hyper-efficiency right now?
It's the sheer scale and the volatility of the current market. The industry is navigating massive capital projects and, at the same time, softening crude prices.
Two opposing forces.
Exactly. Take two headlines. On one hand, you have this huge long-term optimism. Look at BP pressing ahead with a massive discovery offshore Brazil in the Santos Basin.
The boomerang block, right?
That's the one. They've confirmed a very large hydrocarbon column, manageable CO2 levels, and they're planning to drill in early 2027. That signals serious future commitment.
Okay, so that's a huge investment, a clear marker of future revenue. But with that kind of optimism comes the need for massive infrastructure spending.
Absolutely. And the investment required for logistics and environmental compliance is just staggering. The oil field water handling market, for instance, is projected to hit $156 billion by 2030, globally.
Wow.
And here's the real kicker. The Permian Basin alone is expected to account for roughly $102 billion of that. That averages out to $26 billion a year.
Wait, hold on. $26 billion a year, just in one basin, for water handling. That kind of CapEx has to fundamentally change how financial teams track everything.
It does. I mean, that scale requires brutal rigor in distinguishing CapEx from OpEx and managing, hundreds or even thousands of AFEs authorizations for expenditure at the same time.
Right.
Poor accounting controls at that level don't just mean small errors. They mean misstating billions in assets.
And all this pressure is compounded by the headwinds you mentioned. Our sources noted consolidation is still happening, and crude prices are still hovering near break-even for a lot of operators.
And that translates directly to workforce instability. That's a crucial counter-signal. We saw significant upstream job losses in Texas.
Real significant.
Nearly 3,000 jobs lost in just 2 months, June and July of 2025. That's about 1.5% of the entire workforce. So when you shed staff that quickly, the remaining team is overworked, maybe less experienced, or managing unfamiliar systems from a merger.
So the workforce instability itself becomes part of the financial accuracy problem. You're relying on fewer, more stressed people to handle more complex data.
Precisely. The volatility hits you on two fronts. You have the price risk, and then you have the operational risk from staffing shortages. So in this environment, turning the financial function into a competitive edge means every saved day, every prevented error translates directly into better cash flow visibility.
So financial accuracy is now a frontline decision tool, not just a compliance issue.
It has to be. You need near real-time insights into production costs, AFE performance, margin exposure, all of it to pivot when commodity prices swing. That's the difference between leading and lagging.
Okay, let's get practical then. Let's talk mechanics. If you're trying to get that efficiency, what are the leading teams actually doing to speed up their accounting, especially for that year-end crunch?
A strong year-end finish. Well, it requires preparation that starts months in advance. It's all about mitigating the risks we just talked about. For the top operators, a few steps are just non-negotiable.
Like what? What's first?
First, they reconcile suspense and clearing accounts early. These are notorious for harboring these mysterious unallocated balances that can completely derail a year-end audit.
That makes perfect sense. No one wants some massive unknown balance popping up when the auditors arrive. What about the capital projects? Those must be the biggest source of complexity.
They are, which brings us to step 2. Proactively auditing your AFEs and capital projects. And this isn't just a check-the-box exercise. They are actively looking for incomplete approvals or cost overruns now, not waiting until January.
Why not just wait, though? I mean, doesn't adding that extra reconciliation work slow down the regular month-to-month routine?
That's the old way of thinking. Waiting means you're just preparing for a disaster. You discover a massive unapproved overrun that needs reclassification, maybe even partner notification after the fact. The financial and legal exposure of ignoring those early AFE issues is enormous.
Okay, that clarifies the high stakes. What else is critical for that year-end prep?
Finally, they validate production to revenue alignment. So comparing production volumes, prices, ownership decks, making sure every barrel is matched to the right revenue stream. And crucially, they clean up joint interest billing JIB receivables and payables before the year-end distribution.
And that builds partner confidence.
Directly.
Okay, let's pivot to the monthly routine. The industry standard has always felt like this long, painful close. The goal now is to move from that fire drill to a repeatable, measurable process. The big aspirational number is a 5-day close. Is that really achievable, or is that just a fantasy for most operators?
It's aggressive, for sure, but it is entirely realistic for operators who have embraced modern integrated systems. It stops being realistic when you're still relying on manual spreadsheets and disconnected platforms.
So it's about eliminating the manual steps.
That's the core strategy. Automation is step one. Automate every repetitive task you can think of, recurring accruals, intercompany entries. Step two is standardization. Rigid, standardized close checklists with defined owners and due dates. Everyone knows their job.
And that frees up the accountants to actually be analysts.
Precisely. And probably the most impactful change is integrating field data capture systems directly with the accounting platform. That alone can shave days off the process by eliminating manual reconciliations.
You also can't wait until day 4 of the close to find an error. You need visibility all month long.
You do. Leading teams use real-time dashboards. They show accrual status, operational spending versus budget, and any exceptions mid-month. They treat the close like a continuous activity, not a sprint.
Speaking of continuous pain points, joint interest billing, JIB, you mentioned it, it's cited as this perpetual source of friction and cash recovery delays. What are the common preventable mistakes that create this bottleneck?
The JIB failures almost always come down to gaps in data and process. The first, and honestly most debilitating mistake, is relying on out-of-date ownership decks.
So when a partner's stake changes and the system isn't updated?
Exactly. You could be billing a partner for 50% when they only own 40%, and that guarantees a dispute, slows down payment.
And it erodes trust immediately.
Instantly. Mistake number 2 is timing mismatches. This is when the expense recognition cycle and the billing cycle aren't aligned. You get these constant manual corrections. And the third is just simple human error from manual data entry. Miscoding overhead, using the wrong AFE number.
It sounds like fixing JIB requires more than just discipline. It needs specialized tools. So how do you modernize this to build that trust and speed up cash recovery?
Modernization means embedding a validation routine into the core process. You have to validate ownership decks monthly, not annually. You need automated bill run checks to catch errors before the invoices go out. The complexity here often exceeds what an internal team can handle.
Especially a team that's already stretched thin.
Right. And that's why many turn to expert assistants to manage these specialized functions.
That's an important transition. Achieving this level of optimization, especially with data, it requires capacity and expertise that internal teams just might not have. Our sources highlight firms like EAG Inc. What's their specific role in tackling these challenges?
Well, EAG is deeply rooted in the energy sector. They have over 20 years of experience focusing specifically on mining, upstream, midstream, and renewables. They're essentially specialized energy operational and tech experts. Their mission is pretty straightforward: be the industry's first choice for consulting and outsourcing.
So what are the concrete services they offer to solve the problems we've been talking about, like JIB bottlenecks or the 5-day close?
They structure their offerings around 4 core needs. There are consulting services, back office outsourcing, using their subject matter experts for things like JIB and fixed assets IT outsourcing, and then their proprietary tech New Era solutions. They really focus on helping clients automate processes and transform raw data into valuable, actionable information.
Let's focus on the technology for a second. We just said outdated ownership decks are the #1 JIB mistake. How does their tech offering, New Era, tackle that specific pain point?
So this is where that specialized technology becomes non-negotiable. New Era Solutions is an AI-powered land management platform. It's designed specifically for oil and gas complexity. It centralizes and digitizes all those complex legal documents, the leases, the division orders, the assignments that define who owns what.
So it's using AI to basically read the legal docs and keep the system of record perfectly up to date.
That's it exactly. It uses automation to solve the data reliability problem right at the source. This lets clients do more with fewer resources, so they get both cost savings and higher accuracy.
And beyond the tech, our sources also mentioned a case study about implementation speed.
Yes, a successful acceleration of a Quorum TPS implementation for a midstream leader. TPS is a very complex transportation and inventory management platform. By partnering with EAG, they dramatically sped up that whole system's implementation.
Which means they saw the benefits faster.
Immediate operational and financial benefits. It just proves that external expertise can drastically shorten the time it takes to modernize your core financial infrastructure.
This has been a critical dive into the transformation happening in E&P finance. Let's bring it all back home for the listener.
By tightening those close processes, eliminating the chronic JIB bottlenecks, and embracing this high-level automation, E&P organizations gain much more than just cleaner books.
It's faster insights, reliable data.
And fundamentally a clear competitive edge heading into the next fiscal year.
And if we connect this to the bigger picture, this push for continuous improvement is visible right across the industry calendar. Efficiency, as we've learned, is a moving target. It requires constant knowledge updates.
Which really raises an important question for you, the learner, to consider. We noted upcoming industry events like the NetAway 2025 Institute in Boston, which covers these highly specialized topics, and the Nullita Conference in Miami. So if the industry's most dedicated experts are gathering every year to share basic to advanced topics on land and division order analysis, how critical is it that your internal team stays ahead of the curve in these specialized areas? Staying efficient means investing in the continuous education of the people who manage those highly technical functions that underpin your entire accounting accuracy.